Did the Fed just set the biggest bull trap of all time, or should we just stop overthinking this thing and go all in on the long side? Well, let's try to answer those questions by looking at the data points and building a game plan for the rest of this week. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe for 100K by May, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. Let's kick things off with a closer look at the SPY daily time frame chart and ask ourselves the question, what do we see here from a trend point of view? We've certainly got ourselves lows, higher lows in here, and along the way highs, higher highs, and today we've printed a brand new higher high, brand new all-time high. It's the highest high in the trend cycle, and therefore, instead of being in a neutral trend, we're in an uptrend, and we can now afford some sort of higher low pullback without worrying about the trend deteriorating. Remember that prior to today's breakout, this was nothing more than a balance range with lows equal lows, highs equal highs. We were getting some sort of range compression that looked like this, if you will, and now we've broken that in the upward direction. So the trend is up, the bulls are back on parade. So it really begs the question, how do we get trend continuation and how do we participate in trend continuation? In its simplest form, this is a balance range breakout, can see straight up follow through in the upward direction, regardless of whether or not we're extended through the upper edge of this week's expected move. Remember that markets move from areas of compression to areas of expansion, and based on a very quick eyeball test, if we are going to double this range, we're really looking at something closer to the 525 targets. Very quick eyeball test, quick and dirty. I'm not saying we have to go there, but it's a rough area where you might start to find some sellers on continuation into blue sky territories. The next most constructive thing that could happen is some sort of reasonable pullback that finds a daily higher low up and over the breakout point at 517.25. If we can find a higher low here, of course we could go lows, higher lows, the trend remains up. So no issues with that. We could also look for a higher low over this zone right here at 515.25. We'll see why that's important on the hourly chart in just a moment. Anything underneath that really aims for the equal low down here, and this is where we need to address the opportunity for a huge bull trap set by the man, the myth, the legend himself, Jerome Powell. If this is nothing more than a bull trap, how does that unfold? So if you're bearish on this market, listen up. This is what you're looking for, right? You basically want this to turn into a failed breakout, so a look above and fail on the range. If we trade back down to an equal low around this 512 zone on the daily chart and then produce some sort of lower high in the range, that would be right here, that cements this as a failed breakout, and the target is always the bottom end of the balance zone. In this case, that would be 509, and what do we know happens underneath 509? If we can break down through all of these equal lows from in the past, we're really not aiming at 505.25, we're aiming at the NVDA earnings gap down underneath us at 503, fills down to 497. Daily 50 SMA is in there at this point in time. So we're talking about a bearish outcome here. However, let's just clear up the screen and rewind the script. What did we just say? The first thing we said on the daily time frame chart, right? It's that the daily trend is now back in the upward direction with the new all-time high. Is that bearish? The answer is absolutely not. So if you're trying to trade this as a bull trap, if you're trying to trade this as a move back in the downward direction, please be patient and look for some sort of lower high underneath 517.25, so at least you can manage your risk, right? You can go short in here, you can put a stop just above, target the bottom end of the range. Now you're dealing with loosely some sort of 3-to-1 plus risk-reward ratio. If you're just arbitrarily shorting the all-time high, it's really a losing strategy over time. Certainly would not recommend that. So primary outcomes into the remainder of this week are straight up continuation, higher low pullbacks over 517.25, higher low pullbacks over 515.25. In here, we become a little bit more neutral. If we can identify some sort of lower high underneath 517.25, that is where we're bearish. So maybe it does something that looks like this, and you could start to bring out the arguments about, here you go, there's your very classic head and shoulders pattern, the whole 9 yards, that's fine. But what you need to identify if you're going to be a bear, we'll use a nice red crayon here, is the lower high underneath 517.25. That unlocks the downside. Anything other than that is a bullish uptrend looking at a pullback or for straight up continuation. With all of that said, let's get granular now and really explore the nuances of the Tuesday morning session on the hourly time frame chart. So the first order of business is certainly identifying that the hourly trend is also in the upward direction with consecutive higher lows as well as higher highs, and of course on today's session the brand new all-time high. So just like the daily time frame chart, we can afford a higher low pullback without jeopardizing the overall trend, but the levels are slightly different here. On the hourly chart, of course, what we'd like to see is higher lows to stay above 517.25. On the daily chart, it's not the end of the world to get the retest of 515.25, but on the hourly chart, it opens us up for a little bit more of a neutral opportunity in here, just citing that we do have a 100% retracement of the FOMC move, as well as an equal low in the hourly trend count. Again, still looking for the buyers to step up there, but noting the neutrality on the smaller time frame chart. Regardless, let's ask ourselves the question, do we have stronger sellers stepping up in this market? And of course, the first glance answer is absolutely not. Of course, we just produced a brand new all-time high. How could we possibly have stronger sellers in the market? But let's rewind the script here a little bit and talk about what happened on Friday of last week, right? This is where the sellers finally started to flex a little bit and say, hey, we're drifting into an hourly downtrend. We had a gap fill reversal. We closed weak on the Friday session. So in theory, if we were going to produce a bear flag, and we talked about this on Saturday, right? We wanted to see bearish consolidation for that flag to remain underneath 512. So 512 is a key inflection point going forward. Monday obviously opens on a gap up. So kiss goodbye, your bear flag consolidation, but notice that we do reject this area for an equal high on the hourly downtrend, right? And we actually produce a lower high into the afternoon. We close fairly weak. So okay, maybe Monday was just a fluke based on the AI news that we got over the weekend. Tuesday morning, we open up on a gap down, and this is where the gift is given to the sellers. We open on a gap down, and there's an opening drive to initially test inside of the Friday range. If the bears were truly going to come out with strength, this should have done two things. Number one, just battled instantly for price acceptance further inside of the Friday range, or it could have closed the gap all the way overhead, so gap fill reversal off of the Monday low, and then went back down into the Friday range. Obviously, none of that took place, and we really went opening range breakout, and then we closed up here at an equal high, broke to a higher high into the afternoon. So when I look at this chart objectively, Tuesday is really the nail in the coffin for the sellers. We had a gap down. Maybe Monday was just a fluke. We're getting back down into the Friday session of the previous week where we know the sellers had an upper hand with that gap fill reversal into the mid-morning, right? And it just didn't stick. So if the sellers were going to make it happen, this was the time to do it. Did not take place. On today's session, this is where there was bullish consolidation and acceptance into the Tuesday afternoon. Here's this morning ahead of the FOMC. Is there any threat? Do the sellers at any point during the day make a threat to not only break down underneath the Monday high, but underneath the Tuesday afternoon consolidation lows? If all of this was going to turn into overhead supply, if you were going to turn this into a double top, the first step is to at least test the neckline, and to get there, you would have wanted to turn these buyers late to the party on Tuesday into overhead supply, and once again into this afternoon, into this midday session, there is no attempt from the sellers to test the bottom end of this range right here. So when I look at this chart again, I ask myself the question, are stronger sellers getting involved? They had an opportunity here, and on this morning session, if they were to have pushed in the downward direction, maybe, just maybe, it's an opportunity to remain for some sort of daily lower high. It's not the case. We get a new all-time high. There's no evidence of stronger sellers continuing to step up in this market. So getting forensic like this continues to lead me to believe that we want to try to participate in the upward trends that we have on the daily chart, as well as here on the hourly time frame chart. Just to summarize, we're looking for continuation, higher low pullbacks over 517.25, higher low pullbacks over 515.25. If we start to slip this, we will change our tone. So here we go with the red crayon, right? We'll change our tone if we can start to spot something that looks like this, but right now, the evidence is not overwhelming that we have stronger sellers ready to push price in the downward direction. A couple of pieces of confluence, then we'll move into some supporting evidence. Let's come from the low of the Tuesday session to the new all-time high, 38.2, beautiful confluence. Let's get rid of that red crayon. 38.2 right there, 517.25. So healthy bull flag consolidation, absolutely. Looking for follow through in the upward direction. The other thing to point out is, like, if you're looking for a bullish trade and this turns into balance into the end of this week, it sets up the bullish bullish breakout next week for something that does this, or if you can spot the long down here, basically the two entry points are number 1 on the pullback or number 2 on the higher low over today's new high of day. The additional thing to point out is, of course, with the intraday anchored view apps, and if we throw these on, where are we going to get confluence into the end of this week at 5:15.25 to really support the thesis that the daily higher low wants to be held around this zone. This is not the end of the world. We would look for an hourly double bottom, hourly trend reversal, whatever, trading back in the upward direction. If these are going to offer confluence, it reinforces the amount of confidence that we have in that level. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. When we look at this in isolation of the FOMC meeting today, I'm not really thrilled with the buyers on the Monday or Tuesday session, specifically on Monday because we did have a gap up there. So this is really weak volume inflows. The advanced decline line does not get anywhere close to trend higher zone on Monday. Tuesday's okay. It's more of an uptrend happening here on an intraday basis, but again, not in trend higher zone. Same thing on Monday out of the cumulative build in the tick, very neutral and mild. Tuesday, a little bit more credit to the buyers, but we're nowhere near substantial, peaking out around, let's just call it 2,500, half of what's substantial at a 5,000 cumulative read into the end of the day's session. So don't get me wrong, this is not bearish information, but when I look at this data in its totality, it would make me less inclined to try to chase the momentum here with terrible trade location at the all-time high. Really, at the exchange level, I would be more interested in seeing what is the opportunity for a higher low pullback, and can we get involved when and if the internals really firm up on any sort of buying pressure out of a higher low, right? If the market does continue to rip in the upward direction, fine, maybe there's an intraday setup that we can take advantage of, but I would really want to see very, very strong market internals on the buy side, not like what we saw on the Tuesday, Monday session here, volume flows, advanced decline line, ticks, right? Very, very compressed, hugging that zero line. If that's what we're getting as we're just chopping around potentially as a hypothetical, right, near the all-time high, I am absolutely not interested in chasing that move, and I'll be much more patient looking for the higher low opportunities. So at the internals level, at the exchange level, I think that this data really comes together to show us that we probably don't want to be shorts. There's no evidence here of stronger sellers stepping up, but on the flip side of that coin, we really don't have committed buyers, and that's evident in the fairly neutral internals, I would say, specific to the Monday and Tuesday session. Could that be a symptom of going into an unknown event like FOMC? Absolutely. So if that changes into the end of this week, again, if we're looking for momentum setups near the all-time high, we would need to see the follow-through out of very strong internals on Thursday from an advanced decline line, volume flows perspective, as well as tick down below. Let's take a look now at market profile. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's keep it simple and begin with Monday's value area here. Notice that it is breakaway from Friday's value area, so progress made in the bullish direction. And then on Tuesday, look at A, B, and C periods here. Basically, that's your opening range. Had the opportunity to build out value underneath the Monday value area, using this as potential overhead supply to weigh on prices in the downward direction. It simply did not take place. So when we go back and we try to answer the question, do we have stronger sellers entering this market? Volume profile, market profile would certainly agree that the sellers failed their opportunity on that Tuesday morning session. You can see that the value area and point of control actually drifted over the Monday value area and point of control here. A little bit of a spike in that M period, but you'll notice we opened inside, broke out to the upside, obviously via FOMC, and the rest is history. Now, on today's session, the value area and point of control is lower, and this is actually a positive indication for the day. What does it mean? That more people have positions from lower in the individual session as compared to higher and chasing the end of day move post FOMC. So it's going to be harder to turn those folks into overhead supply. If the market is really going to break down aggressively, you probably want to see a move underneath today's low of day. And that makes complete sense based on what we just discussed on the 1 hour time frame chart, jeopardizing not only an equal low, but on the hourly chart, breaking down underneath today's low offers some sort of lower low on the hourly time frame chart. Not the end of the world, we can still get a daily higher low, but it's the first step, and it starts to make this more likely to turn into overhead supply. So one consideration there. The last thing to point out on the market profile is that we did repair the back pocket poor high we discussed from this sort of triple top back down over here. So now that we've traded through that, this level is repaired, and if we take a look at today's high of day, we actually have a lack of material excess in the M period. It looks like we're starting to threaten a little bit of a gap up here. We'll see what happens by the time the 9:30 bell rings. But if we are going to repair this level, we're just looking to trade through it. Is this thin structure? Yes, sort of. And I think that this more so aligns with the breakout level and the retest level we were just discussing as the previous all-time high on the S&P 500s. That's going to be your 517.25 level. Here in the S&P futures, we're talking about 52.50 towards about 52.52. Those are the key levels I would use here in the futures. Changing gears to the QQQ NASDAQ 100 on the daily time frame chart, what do we see here in terms of the trend? It's certainly neutral. We've got all of these equal lows building a flush point at 433.75 as the gatekeeper to the NVIDIA earnings gap down below. And along the way, we had highs, higher highs, maybe higher highs. Here was a lower high, and there's an opportunity for an equal high, still a potential lower high from here to here. So I'm not convinced that the daily trend is bullish or up at this point in time. It's really more so neutral inside of this balance range here. If we're going to see constructive moves in the upward direction, I would really like to see consolidation remain above at this point, this level right here at 438.50. We'll see why on the hourly chart in just a second, but consolidation in the upper 50% of the range gives me at least a little bit of hope that the buyers might aim for follow through up and over the top of the balance range in here. For that to take place, you're really aiming for a breakout up and over 444.50. We'll see that again more specifically on the hourly time frame chart. So consolidation here breaks higher lows over 444.50. That's what we're looking at if we are trying to be bullish. If this is a bear trap, if the sellers are going to build an edge, the QQQ has shown us time and time again that sellers do not get follow through here out of this market. Even look at what happened on the Tuesday session. At the low of that session, we were testing the NVIDIA earnings gap after consecutive lower highs on the daily and hourly time frame chart. There was no follow through in the downward direction. So if a stronger short is going to emerge out of the NASDAQ, I would really encourage patience until we are clearly moving into the NVIDIA earnings gap with a clear lower high underneath 433.75. Outside of that, we have to give credit where credit is due. Gap fill reversal closed at the highs of today's session, so maybe there's a small bullish edge in the immediate term. Let's take a look at the hourly time frame chart to either confirm or deny that. I would argue, yeah, we are dealing with an hourly uptrend. We have lows, higher lows happening here along the way. Highs of Tuesday's session, Tuesday here as well, today and into the close. So a very short-term hourly uptrend here. If you were going to be a pattern trader, this could perhaps constitute a double bottom. And from that point of view on the hourly time frame chart, obviously the most bullish consolidation wants to happen above 441.50. If you can get bull flag activity here, looking for the break up and over 444.50, then from there we will target this all-time high level at 448.50. So let's make that a nice round number, rule number 2 up in the penthouse suite. So bull flag consolidation is bullish, breaks higher lows. That is what the buyers are aiming for. This is okay, but really more so neutral. And then slipping underneath the base of the FOMC rally really offers the opportunity for a lower high underneath this key structure. It was the first high set from back here in this overall balance that we're dealing with. A lower high underneath 438.50 really strikes me as the nail in the coffin. You're still dealing with an opportunity for a daily lower high, hourly trend reverses underneath, and of course, the larger threat is the NVIDIA earnings gap down underneath us. Do not jump the gun on the short side. There's nothing instantly jumping off the page saying, hey, this is your short, heads up, short here, short here. Not right now. We're still in an hourly uptrend. Lows, higher lows, highs, higher highs, right? So unless that changes, if we drift into an hourly downtrend, maybe this is in play, but not top of mind considering what's happened into the close of today's session. The same thing applies in terms of the failures from the sellers on the Tuesday morning session, right? Here's our big gap down. It's even bigger than the gap down in the S&P 500. We get opening range that tests the lows of the Friday session from last week, and there is no follow through into the gap. So if the sellers were going to have something going on here, they should have made it happen on the equal low attempt after a lower high from here to here. Did not take place. Opportunity number 2 would have been a gap fill reversal underneath the low of the Monday session, right? Something that looks like this, equal low reattempt, and then we look for the breakdown. Obviously, we close strong at the highs of the Tuesday session. All of that goes without saying. It's the same analysis intraday that we applied to the S&P 500. Let's take out a couple of Fibonacci points of view, and then we'll really really finish this thing off with the internals and market profile, you can see here that we are technically over the 61.8 as of today's close. The more time we spend over the 61.8, the higher the likelihood of a 100% retracement. So that's interesting to me. I'd also point out that the inverse of that is true. So if we can stay over the 38.2, the odds would decrease for a retest of this as an equal low at 433.75, the gatekeeper for the NVIDIA earnings gap. And we can also come in from here up to here. Any reinforcement from that point of view, not really on this Fibonacci side of things. Maybe the 61.8 loosely aligned with this level at 438.50, just sort of reinforcing the idea that this is okay. This is still sort of neutral to bullish. This is even more bullish, looking for follow through. This is a trade to the long side. And if we're short, you really want to be back down underneath that 438.50. What about the anchored view apps intraday? Then it's over to the market profile and internals. You can see that these are clustered right now at that key level 438.50. So once again, just reinforcing that as a key zone. Let's take a look at the internals for the NASDAQ side of things. Exact same commentary as the S&P. Pretty weak and neutral show of strength, if you will, from the buyers on the Monday, Tuesday session even, as well as the cumulative build a little bit stronger out of Tuesday on the long side, although still not substantial, 3,000 on the positive side towards the end of day there. And on today's session, really way more flat than seeing that stronger read build throughout the morning and then accelerate on the FOMC. So still a little bit skeptical out of the NQ for those reasons. We're still thinking about the opportunity for a neutral daily trend that we were just talking about over here. If you're trying to be bullish on the NASDAQ, it's really a patience play and looking for that confirmation of, at this point in the Qs, staying over 438.50. You really can't afford to get back down underneath that particular level. Here are the market profile looks of the NASDAQ futures. And just like the S&P, I would primarily point out, look at all of the opportunity on the Tuesday morning session, A, B, C, D, even some of E period there, representing an opportunity for that lower sort of acceptance, that value area to stay lower below the Monday session over here, weighing on prices, overhead supply. Obviously, the point of control migrates higher, value area migrates higher. Poor high was repaired on today's session, and just like the S&P, so this is bullish, right? The fact that the sellers could not capitalize on this breakdown, that gives the gift back to the buyers. And then on today's session, the value area and point of control are certainly lower in the overall session. So just like the S&P, if this is going to turn into overhead supply, you really need the breakdown of today's low of day. If you're underneath that level, then great, all of these buyers are trapped. But as of right now, you could retrace into some of the FOMC move and still not jeopardize a bulk of the position, which, as you can see based on the point of control, is almost smack on to the low of today's session. And last but not least, for our broad market ETFs, we've got the IWM Russell 2000 and the small caps on a daily time frame chart. What do we see here in terms of the trend? It's a little bit more confusing. The weekly trend is up. We've got lows, higher lows, and an opportunity for higher lows. And this is a very important weekly higher low because it's over the daily 50 SMA. It's over the neckline of this as a double bottom, or even if you just wanted to refer to it as the breakout point of an ascending triangle. So if we can hold up over 199 on the weekly higher time frame charts, we're good to go. On the daily time frame chart, the reason this is somewhat perplexing is because we have a high, a lower high opportunity here, and a low was set after we attempted to rebound, right? From there, you can clearly see we've got lower lows and now an equal high. So the daily trend is in the process of neutralizing, and if we can produce some sort of daily higher low, that would start to cement a new and budding daily uptrend. So where does that higher low want to form? Well, based on a line in the sand, we would call it down here at 202.75. You would want to see the top of this balance area, prior resistance, now act as newfound support in the upward direction. But I would argue the level you really want to focus on is right here at 204, because the whole reasoning, the whole breakdown came from the head and shoulders neckline at 204. So in the most bullish sequence, we would then turn that previous support into newfound support once again after having recaptured it. So 204 strikes me as a key level of support as we move forward into the remainder of this week and even possibly next week. I do want to remind you on the weekly time frame chart, I know we talked about weekly trend, but here it is visually, right? The $200 level, the 199 level right here, the daily 50 SMA, the neckline of the double bottom we were just referring to, is so crucial because of what it represents here. It's the top of a multi-year weekly balance range, and if we can hold that for the next weekly higher low that is very constructive in the upward direction and speaks to the broadening nature of the market rally. The only issue with this is that it is massively divergent from the fundamental story that we just had updated by the Fed's SEP, Summary of Economic Projections. We'll get to that stuff in just a moment. We know that small caps should, in theory, be extremely sensitive to interest rates, and based on the SEP, there is likely no cut coming in the month of June. I don't know why the market's still pricing it in. We'll talk about the dot plot in just a second, yet the IWM rallied aggressively. So, from a technical point of view, higher lows over 204, we have to trade price action, right? If you are a trader, you trade price action. You don't trade what you think should happen based on the SEP. I want to be very clear about that across all of the analysis we've performed thus far on the S&Ps, the NASDAQ, and now the IWM. We trade price action. You can think about sort of fundamentals as context for the price action and how aggressive you might want to be. And although it's divergent, it's not enough to go out there and simply say, we're going to start building a massive short in the IWM. If you really want to go short IWM, get it underneath 200. That's where the short emerges for all of the reasons we just saw on the weekly. That would be a huge weekly breakout failure, right? So let's move on down to the hourly time frame chart. Let's get a little bit more nuanced here. I suppose we can get rid of those anchored view apps for now, then we'll throw them back on in a moment. You can see that this is our reversal in the upward direction. So just like we talked about on the daily, line in the sand for a higher low pullback is over 202.75. Even better would be the neckline here at 204, something that looks like this, trading in the upward direction. What does this mean for the S&P 500 if the IWM can find a higher low on the hourly over 204? I would not be aggressive in terms of thinking about the sort of big bull trap, so to speak, air quotes around that one, hence the title of today's video, right? The bull trap in the S&P is likely not a trap if the IWM and small caps find a higher low over 204. If IWM starts breaking down underneath 202.75, consolidating below this level, absolutely bull trap. Watch out, look out below, run for the hills in the S&P. That would not be a good sign for the buyers, right? A 100% retracement of the move, which is also indicative of like, hey, we do not believe rate cuts are on the way, with weakness that we just saw in the QQQ, which is really more sideways inside the range still. It hasn't broken out to a new all-time high. All of that added up, this speaks to context, all right? So the IWM is going to be a huge gauge, a huge way of determining whether or not the S&P is ultimately a bull trap at the end of the day, the end of this week. Let's take a look at the Russell internals, and you can see the same thing happening here. Monday, a little bit of weakness. Tuesday, a little bit of strength, really flat ahead of FOMC. It's very difficult to read into this and say, oh my goodness, there's a strong bullish edge that's emerging, right? Maybe a little bit more strength on the Tuesday session via the cumulative build down here in the tick, and maybe a little bit more trending activity in the advanced decline line, but not enough, I would say, from Tuesday in particular to really strongly say that, okay, we're safe, quote unquote, air quotes there, right? Safe in the broad market as a whole. If we just go back over here, Tuesday when the internals were strong, it was technically from a gap down. So sure, some progress was made, and sure, we can read into the fact that if stronger sellers were going to appear, right, they should have been gap fill reversal, and you can see a little bit of that in the first hourly upper wick of the IWM. You can see that we tried to reject it. The sellers tried to reject that there, but we really battled back for acceptance in here. So stronger sellers, no, but did we really see like, oh my goodness, markets in the IWM are breaking out of this weekly range with momentum? I would say that that is a far stretch as well. So the name of the game right now is really trying to navigate the wake of the FOMC announcement and Jerome Powell's commentary. Here is the market profile for the Russell futures, and I would just point out all of the same things we've talked about in the other indexes. Here is Monday, lower inside of the range point of control. It's not even central in that range. All the volume goes through an M period towards the day's close. Technically, that's a spike, right? We opened underneath. Gap fill reversal was an attempt, but the sellers cannot make it stick down towards the lows. I would probably make the argument out of small caps that if we start breaking down underneath 2055, which sort of separates this upper distribution from lower distribution on Tuesday, that's where the stronger selling may emerge. You'll notice that the point of control is slightly higher on the IWM and the Russell futures compared to the S&P and NASDAQ, which had a point of control down here. But because of the way that the volume is distributed on the Tuesday session, that's really where we saw, if we just flip back over here, the internals, that's where we saw the stronger buyers show up, right? Because of that, I would really argue that over here, we want to focus on that level we just described, around 2055. If we're over it, still okay. If we start to break down underneath, that's really where I think the danger steps up in terms of momentum re-accelerating in the downward direction, because now this trapped overhead supply, trapped overhead supply, trapped overhead supply, when when you accelerate underneath, that's where I think the weekly breakout really comes into question as, is this valid, and why is the broad market itself, hence the S&Ps, right? Why is that not really moving aggressively in the downward direction in tandem with a weaker small cap market? And let's continue to get granular as we typically do, checking in on the weekly performance of our S&P sectors. Leading the pack here this week is the XLY consumer discretionary up 2.12%, followed by financials up 1.91%, and then we have industrials up 1.89%. As we know, discretionary and financials are heavier weight risk on style sectors, so the posture does strike me as okay as we're breaking out to new all-time highs. We do, of course, want to check in on the XLK, the tech sector, the heaviest weight risk on sector that there is, up 1.26%, equal performance to the S&P 500 itself on the week thus far. At the bottom of the barrel, the only red name on the list is the SMH, which is somewhat ironic with all of the sort of AI news happening. We've got NVIDIA's GTC conference, we had the open sourcing of Grok, we had Apple announcing a partnership with Google to license the Gemini model, Apple released their own model, right? So all of that's going on in the AI world, yet SMH is down 40 basis points, the only red name on the sector sort of lineup. And I get it, it's not an S&P sector, so let's check in on the laggards still. We have the XLV, the healthcare sector, as we know, D for defensive, but the second heaviest weighted sector by market cap. So the fact that it's not red is somewhat encouraging, right? Above that, we see the real estate sector, lighter weight sector, and the XLB, the lightest weight sector there is, and green is green. Like, let's not get it twisted. Green is green at the end of the day. Let's check in on the structural charts and evaluate what's happening from that point of view. So summary on posture is that it's not the end of the world. It's actually pretty good as we're breaking back in the upward direction here. XLY, consumer discretionary, color me impressed. I mean, honestly, look below and fail and already through the top end of the range. Anything that stays over 182 is inherently bullish, or higher low pullbacks that then find support over the original bottom end of the range around 180 flat offers up a very classic inverted head and shoulders, and we're still off to the races on the buy side of the market. So this is bullish overall for the S&P 500. I would be more concerned if this breaks down underneath and finds a lower high here around that 180. Certainly doesn't look likely based on today's action, closing strong at the high of the session. XLF, another one. Color me, not so impressed because this ultimately was in an uptrend, and based on Saturday's update, we said that financials might save the day. It looked good as long as we were over 40.45, and we certainly held over that on the Monday low of day. Tuesday follow through, today's session follow through in the upward direction. This is bullish. We have ourselves a new higher high. The trend is clearly up. Higher low pullbacks are welcome. We're scratching right at that all-time high. Financials, bullish for the broad market as a whole. Industrials, looking good as well. Breaking out into blue sky territory is very simple. Higher lows can be achieved, and it will remain bullish here. Even if we slip down in here, sure, it's a failed breakout, but on the weekly chart, we could use some consolidation. Strong move in the upward direction. I'm not calling for that, right? There's a very strong close here, but I am saying it would be okay on the weekly time frame chart. Next up, XLP, consumer staples, D for defensive and a lighter weight sector, did not make a new higher high in the sequence yet, but it's coming off of a higher low. The trend is very mechanical, and it's certainly up. I'm still bullish on this sector, but posture-wise, not the end of the world. This is not what led to the majority of the gains this week in the S&P 500. You can clearly see it was driven by consumer discretionary. Next up, utilities, another D for defensive lightweight sector. Is it outperforming even on the announcement of the FOMC? Absolutely not. It's stuck in this balance range. It's constructive. Remember, upward pressure is upward pressure. If we can stay over this neckline, great, but we don't want it threatening outperformance. It is certainly not based on the structural chart. Next up, XLC. Communications, what do we see over here? Pretty decent look. Remember, we talked about look above and fail, maybe working the second go around. Not so fast, not so fast. Higher low, gap fill reversal on Tuesday, closing at the highs on today's session. This is bullish. It offers another opportunity for a higher low above 80. Good to go here. Very difficult to be a bear when we're looking at the major sectors so far. XLK, of course, is going to be a bit of a laggard in terms of price, advancement, we should say, just like the QQQ was, but we're closer at least to this breakout level. Ideally, walking forward from here, we get price acceptance over 208. If we can get this consolidation that's bullish, away from the bottom end of this range, away from the NVIDIA earnings gap up. This looks good, breaks higher lows over 212, good to go in the upward direction. If we start to fail underneath 208, that to me is cause for concern, right? You can see on the Monday session that upper wick rejecting the two lows from the, what would that have been, Thursday and Wednesday of the previous week's worth of trade. So underneath this, I start to become much more concerned about the opportunity for a lower high. And of course, being the heaviest weight risk on sector, really have to be, you have to be very attentive to that threat underneath 203.90 to close the NVIDIA earnings gap. So Possibly something to be on your radar, but based on today's stronger close on the individual session over 208, trying to give the buyers the benefit of the doubt, considering the all-time high in the S&P. If we get consolidation here, open-minded to this as an outcome. If you notice we are not getting this, if we are getting sharp one of these and consolidation here, red flag for the market. All right, so very, very watchful, very, very mindful of the XLK into the end of this week. We've covered the spiders. Let's take a look at energy. It's a lighter weight sector, but it is going to start acting as an inflationary force. Here's the 5-year monthly chart. Look at this massive bull pennant. If this breaks out into the summer, again, kiss expectations about inflation goodbye based on energy services. And today was really all about, talking about inflation expectations and, sort of the trajectory that we're on. We'll get into that in the fundamentals, but energy does not look good on that front, which is a small red flag. As of right now, small red flag. It's not a big one yet until we actually break out of that huge pattern we were just referencing. Here are materials scratching at all-time highs, upward pressure, really lightweight sector. So even if this all turns into overhead supply, not really that concerned. Looking for a weekly high or low. I would be more concerned out of materials if there was like some Armageddon crash that looked like this. Certainly seems like a lower probability considering everything we know. Here's real estate. What do we see out of real estate? Rate sensitive, obviously, ticking back in the upward direction today after the FOMC, but still underneath this inflection point here. It's a really lightweight sector, and what do we always say about these? It becomes more important when you break a key inflection point, basically a bigger pivot, right? If we were to make a new higher high, bullish. If we were to make a new lower low, bearish. As of right now, we're just literally in the midpoint of this as a range, really not all that insightful out of real estate. Here's the XLV healthcare sector. You can see that we've got ourselves a flush point happening here. If we were to break down underneath it, you are technically triggering a double top, or let's get creative here. Let's bring out the Man Ray pattern, right? Underneath that as a neckline, breaks us down, maybe looking for a weekly higher low, but remembering that this is a D for defensive sector. If a sector is going to pull back as the market's breaking out to new all-time highs, ideally, it's a lighter weight defensive sector, but it certainly cannot afford to be a heavier weight risk-on style sector. So right now, considering that this is defensive, I would say it's technically okay. If we look at the structure from today's session, it's an inside bar supporting off of this level. I would just be very open-minded to the XLV. If it breaks down, it's going to be more difficult to see follow-through out of the S&Ps because of the weighting in healthcare, but it certainly wouldn't strike me as being the end of the world, considering that we're just, we're basically consolidating and digesting at all-time highs. Like, do not forget that fact of where we're at on the weekly, right? Next up, SMH. What do we see over here? The only red sector on the week so far. This is a key inflection point, right? NVIDIA is slowing down, and we'll talk about that in just a second. The NVIDIA gamma squeeze, right now, it seems like it's almost over. So if that's going to unwind, SMH could see this as a possible lower high. I wouldn't jump the gun on the short yet until we clearly have a breakdown of this level at 212. Maybe the NVIDIA earnings gap is a target after that. But if there's going to be a breakout, right, this could be constructive. If this finds its way and it climbs its way up the list into the end of this week, that would be bullish for the broad market as a whole, really indicating that, we're slowing down, we're consolidating in semis, but we're not aggressively breaking down. We're not, giving back a big chunk of the move. So if this is going to hold as the next weekly higher low right around in here, getting over 224, consolidating up here is the next bullish step. If you're a bear, you want to see continued consolidation here, breakdowns underneath this level. It's all about the NVIDIA earnings gap underneath 212. Here is the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's keep it brief on this one as much as we can. The XLK is still a little bit of a red flag. It's got some work to do, but no surprises there considering what we just saw on the structural chart. This is not an issue from a risk-off perspective. Financials are starting to break out through this flat top. We'd like to see a little bit more acceleration here, and that would be a green flag. This would be bullish for the broad market as a whole. The XLY is outperforming on the week, but it's still underneath a downward sloping 50 SMA. This is just like the XLK. A small red flag. It's not that we have risk on completely fading here. It's not that the XLK is in an aggressive downtrend, but things could be better from a risk on point of view. If we look at the XLP, XLU down below over here, this is not an issue. This is not an issue. Energy, inflationary, as we know, and real estate as a hard asset defensive, not an issue either. So risk on is the primary look, but it could be better as of right now. Let's take a look at the XLK over the SHY, trying to break up through these equal highs. If it can, that would be a bullish bullish signal for the market. Let's take a look at the XLK XLU. This is avoiding a breakdown, but certainly not accelerating back in the upward direction, really building out more of a descending triangle here. If we break down underneath that neckline, underneath that base, much more of a red flag. So there are some things to still be very closely watching in terms of risk on versus risk off, where the market may flip here. It's not like we're free and clear in the green. And once again, hence the title of today's episode, could it be a bull trap? It could be, but we're just not all the way there yet, if you will. Here's the XLY, XLP apples to apples, opportunity for a lower high, but still trying not to ignore this as just a higher low sequence over time. I would make the argument that staying inside of this consolidation here is really more constructive in the grand scheme of things for this apples to apples comparison. If we were to break down from this, if we were to really trade to the equal low at 2.23, that would be your larger red flag out of this ratio. Next up, we've got the SMHXLV, so semis versus healthcare, trying to tick back in the upward direction. So still bullish on this front as well, well above an upward sloping 50 SMA. No concerns from that point of view. So mostly still a risk on market, but again, a couple of concerns, things to be at least watching for into the end of this week. Here's the dollar drifting in the downward direction. Thanks a lot, Powell. Not really tightening up financial conditions there. An easing dollar should put upward pressure on equities, and that's exactly what happened. Let's take a look at the gold contract. This is continuing to break in the upward direction over this high. Remember, this is all-time highs. It's a massive monthly cup and handle that's breaking out here. Even if we were to pull back, this is not really the end of the world. Any higher lows over 2090, huge signal out of gold, watching for that higher low. And it still brings up the question, like, why is gold being preferred as a hard asset right now? Typically, this is D for defensive, and I get it. It can be seen as a currency. Everything is expressed in terms of currency relationships when it comes to gold, right? But as a commodity, as a physical gold seen more defensive, why is this breaking out? Why is the price of gold so aggressively moving higher when equities are also moving aggressively higher? Like, the magnitude is just the concern here. So watching out for that. We know that a higher gold contract should, in theory, put downward pressure on the dollar, continuing to ease financial conditions for equities down below. So the bullish relationship still maintains itself. Let's check in on silver. We haven't done that in a little while now. I think we've skipped a week. So silver also looking great. We talked about the possible break up and over the shelf to follow gold, and it absolutely did. All good on that front. Let's take a look now at the TNX interest rates. This is where the rubber hits the road. I'm not convinced. I'm not convinced. So where does the skeptical Matt start to step in? Where does the bearish side of Matt start to step in? It's when we're looking at charts like the TNX, right? As we know, if this breaks out up and over 4.33, that's where we start to see some further downward pressure in the NASDAQ. And as of right now, from a technical point of view, we'll talk fundamentals in a second, but technically, low equal low, higher low, back up to an equal high. If this holds as a higher low over 4.2 or 42 in the TNX, right, we're really looking for a move in the upward direction. Once again, that's downward pressure for your QQQ. That probably makes it more difficult for the S&P to find follow through at this new all-time high. So it's not enough to go out there and just say, oh, we're going to short the market because the TNX looks like it's about to break out, but it certainly acts as a big headwind for the market if you're trying to be a bull and align with the daily uptrends we've just identified. Here's the inverted ZT. In terms of what the Fed and our expectations are, it's actually signaling neutrality sort of through that June meeting, still expecting some sort of cut in June. Let's get into the fundamentals and talk about why I am still not sold. So I'm thrilled to announce that the Fed tracker tool got it right for today's meeting. There was no change in Fed policy, and we're still expecting a continued higher for longer pause in the next May meeting. But what becomes slightly perplexing is the idea that the probability shifted firmer towards a cut in the June timeframe meeting after we just got too hot inflation prints and Jerome Powell even acknowledged that it's a bumpy road to 2% and that we're sort of stuck right now at 3%. Based on those words, I would have imagined that the probabilities actually shifted towards a pause and we really had 60-40 odds for a pause, 40% odds for a cut in the June timeframe meeting. So let's actually take a look at the updated SCP Summary of Economic Projections from the Fed. And what you'll see over here for 2024 as the median Fed funds rate is a continued hold at 4.6. This was the projection that they made also back in December of last year. This is interesting because if we look at the core PCE expectations, they actually bumped them in the upward direction, meaning that it's likely going to take us longer to get to that 2% goal if they're not adjusting this number down below as well. We went from a 2.4 core PCE to a 2.6 core PCE by the end of this year. The only place where they budged and made things make a little bit more sense is what's happening here in the longer run rate section. You can see for 2026 bumping up to 3.1 and here from 2.5 to 2.6. That's interesting to me because if we actually take a look at the dot plot, this is what people refer to as the dot plot here, you can see that a majority of the votes were actually at the 4.6 for 2024, but that's the median. Right? If we actually take an average here, you can see that there were far more votes to keep it higher than 4.6 and far fewer votes, a singular vote, to actually get it down underneath 4.6. So the median versus the average is something to pay attention to out of the actual dot plot. And it's in my view that if we get any more hot inflation reads, even if we don't get an updated SCP, you could probably imagine that some of these dots lift in the upward direction, shifting the median rate for 2024 slightly higher than 4.6. So is the market getting a little bit too optimistic just purely based from a numbers point of view and a display of information point of view? I mean, if you just looked at this and only saw the 4.6, you're probably like, oh, great. No issues. The Fed's going to cut rates all 2 to 3-ish times that they've been talking about. Whereas if you actually took a look at the dot plot, this would sort of not necessarily align with that, at least in terms of 100% confidence. The other thing that I really want to draw to your attention is if we scroll down through the SEP, we could take a look at risks to unemployment rate. So you can see that there are broadly balanced risks. This is the March projection. The dotted line is the December projection. So the balance is coming firmer into place in terms of risks to the unemployment rate. So the labor market, right? They're seeing more risk there now compared to where it was prior. And you can also see, less risk. My apologies here. You can see weighted to the upside was here. Come the December read, it's more broadly balanced now as of the March read. So my apologies on that one. This is the one that we need to focus on. So risks to core PCE inflation. This, of course, represents price stability, the dual aspect of their mandate. And you can see that odds increased, or the weight to the upside increased in terms of the risk for inflation reigniting. So if you actually look at this chart right here and scroll up to the dot plot, it makes sense to me that taking the average of how the participants responded, not just the median, would suggest that the rate for 2024 may not firmly stay here at 4.6%. I just don't see a world in which that happens when you actually look under the hood of this surface level table 1 projections, right? So that's my take on the FOMC from today's session. It doesn't mean we go out there and short the market with both hands. As we talked about structurally, if we're traders, we trade the uptrend in front of us. If the market starts to reverse, we at least understand why, and it's probably based on a revision or the market's perception of a revision to these numbers over here. Here's the calendar for the remainder of this week. You'll notice that we have PMIs on the Thursday session. That's tomorrow morning at 9:45. Keep an eye out for that. Also, unemployment claims. We always get those on Thursday, right? And then on Friday at the 9 o'clock time frame, Jerome Powell will come out, and I'm very, very curious to see what he has to say now seeing the reaction from the market. The market breaking out to the upside has unwound some of the activity or some of the progress that they had made in terms of making financial conditions more restrictive. So we'll see what the follow-up commentary is at the 9 o'clock time frame Friday morning. And here is the earnings calendar into the end of this week. Micron reported after the close today. After the close on Thursday, these are your 3 honorable mentions. And let's move into the risk appetite of the market. TLT ratio to the S&P is not indicating a flight to safety, so risk on and risk appetite remains strong for equities down below. Let's take a look at the bonds in relationship to themselves because these are starting to call the bluff of the market, right? The market broke out to new all-time highs on the sort of idea that we are going to be getting rate cuts, and bonds in relationship to themselves are saying, no, not so fast. There is certainly an opportunity for higher lows. We're sort of in range compression as of right now. Maybe these are higher lows as well. So I'm very interested to see how this relationship plays out into the end of this week and whether or not this is picking up on the more nuanced take of the SEP that we just sort of walked through. Remember, the bond market is generally seen as being a little bit more astute than the equities market. So we'll see how those relationships play out. Next up, credit spreads. You'll notice that they are drifting still in the downward direction, so no risk or lesser risk of a credit event is how I should phrase that one. Let's take a look at the HYG in isolation breaking out to a new high, just like the S&P did over here. But let's not forget that we are still massively divergent from the early stages, or I should even say late stages of 2023, December, right? So here's a high, lower high, still technically massive higher high. So don't forget about that. But in terms of actionable takeaways, this in the short term as a higher high is bullish and playing along nicely with the equities market down below. If we break down underneath 7660, to me, that is still the larger concern for high yield in isolation. Let's take a look now at Bitcoin. Speaking of high risk, high reward, everybody seemed to be freaking out about this pullback over here, it's nothing more than a mild pullback off of the all-time high after a very impressive breakout from Bitcoin. So to me, I mean, not that I played this long or anything, that's not what I'm trying to get at, but geez, I mean, the headlines really make this thing overblown, and I get it, they're trying to get emotions involved, but a mild pullback, if we throw a fib on this just for the sake of having some fun, it's probably well above the 38.2, right to the 38.2, so very mild and acceptable bullish pullback out of Bitcoin. This does strike me as a risk-on indication for the broad market as a whole. Let's take a look at some breadth indications. New highs versus lows rebounding in the upward direction is, of course, bullish. If we take a look at the SPX A200R, moving in the upward direction is, of course, bullish. SPX A50R moving in the upward direction is, of course, bullish. What about breadth in terms of equal weight indexes? Here's the RSP equal weight S&P. Notice that we did not break out to a new all-time high. So if you are in camp, oh my goodness, this is the biggest bull trap that Jerome Powell has ever set, then this would support your sort of thesis. Let me ask you this question. Does this one data point sort of give you enough confidence against everything we've already discussed in the sectors, everything in the analysis itself, to go out and short the market? I would tend to think not so much. So take this with a bit of a grain of salt. It's not enough to, again, build a big short position. If you want to be skeptical of longs, that's fine, but I certainly wouldn't go short. Same commentary over here in the QQQE. The weighted down below did produce a lower high. Still, we talked about that divergence, but a little bit more of a lower high out of the equal weight index. Let's move along and talk about the Dow Jones Industrials versus transports. Man, these things have been divergent since, mid-December. So do with this what you will, but it's really not an actionable data point. We're moving along. Next up, we've got the VIX. What's going on with volatility? This is an actionable data point in my view. Breaking down from this support trend line is bullish for the broad market. Breaking out through the upper edge of this week's expected move is bullish. If there is going to be a gamma squeeze, if there is going to be an options-related squeeze in the S&P to the upside, this is helpful for that narrative. Notice the VIX breaking down is bullish. Okay, it's also happening after a lower high. Now, not that you would classically apply technical analysis to this, right? It's a mean reverting asset, but let's take a look at the VVIX, volatility of volatility over here, also aggressively moving in the downward direction. So if there were concerns about a possible breakdown, it really struck me that on Friday, we had elevated concerns. As of right now, post FOMC, absolutely not. We're actually working our way back down towards the complacency zone at 75. If we take a look at the VIX futures, they are certainly working themselves into a deeper contango. There is no backwardation. That, of course, is bullish. Money managers are comfortable allocating money and capital right now to assets. That is risk on. Same thing here in the 9 versus 30-day VIX and the 1-day VIX. The only red bars tend to be when you're getting an FOMC, ironically enough. So as of right now, that has held up. It is moving in the downward direction. Volatility is a non-issue. I would say structurally, we are bullish. From a technical point of view, we are bullish, but fundamentally, there are still some questions yet to be answered, and one of the things I would continue to keep an eye on, just to end on this note, is bonds in relationship to themselves. All right, if you've made it to this point in the video, you know what to do. It's 100K by May. I'll leave it off at that, and we'll kick things off with Apple on the daily time frame chart, looking for a possible lower high rejection around this 180.25 level on the daily time frame chart. We know we're in a downtrend with lows, lower highs, looking for a lower high, even if it's a weekly lower high, up against 180.25, the massive flush point that we were building for quite a couple of weeks. If we can reject that and roll over, the first target is the top of this range at 173.75. If we break down further than that, it's the equal low target at 169. Let's take a look at the hourly time frame chart to make sure we're not missing anything here. I would say that on the hourly chart, there's still some room to get to that 180.25, right? How might we achieve that? Any pullbacks, higher lows over 177.40 are tradable in the upward direction. If you can spot the entry here, stop goes here, target is up here, there you go. When we get up here, we're looking for the double top, we're looking for the head and shoulders, we are looking for the very simple hourly inverted hammer. That would suggest sellers are stepping up on that retest level. From there, as we've already pointed out, the first primary target on the daily is this retest at 173.75. If we do not get there in the first place, if there is a rejection underneath 177.40, I would tend to be a little bit more neutral through this zone over here on the hourly chart. You are technically building out some sort of higher low sequence there. So a little bit open-minded to being neutral through there. If the sellers are really going to make it happen, show me a big time lower high, equal low reattempt, and we'll take it on the breakdown back underneath 173.75. Next up, Microsoft. What's going on with Softy here? Trading back up towards the all-time highs, equal highs. I think the name of the game is very straightforward. Daily higher low pullbacks are certainly welcome over 419.25. Equal high breakouts into blue sky territories are over 426.75. Very controlled, very methodical trend here. Look at the give and take. It looks pretty good to me. I'd be looking at any of these possible highs for intraday higher lows, right? If this consolidation takes place, great, looking for upside. This pullback takes place, that's this level right here, great, looking for an hourly upswing back in the upward direction, some sort of reversal off of it. So I'm not going to get too level happy there, just looking for reversals, looking to maintain the bullish stance if we're over 419.25. If this is going to turn into a double top, let it do its thing. You know where the neckline is, it's way down here at 412.50. So be patient if you're looking to short softy. Next up, Google. What do we see out of Google? Impressive recovery after trying to fade some of the gap over here. Of course, FOMC sort of saves the day, making an equal high. Very straightforward setup. If you can break out up and over 148.60, great thin structure retracement, looking for 151.15. If you just consolidate down here, it's nothing more than bear flag consolidation, looking for the gap to close over time. This is a very straightforward setup. So 148.60 or 146.25. Next up, Amazon. What's going on with Nancy? You can see the clear break into the end of the day over this balance range here at 176.50. Higher lows above keep us bullish, looking to operate in this zone. Entries, stops, targets, right? If we do get straight up continuation, do not be the suckers long up here. Wait for the higher low pullback. Either enter on that higher low, equal low reattempt, or the break and higher low over 179.50. Upside targets are way overhead. Remember, there's plenty of range to trade for overhead at 185.25. If we consider this a balance range, it's a little bit shy of a true range double, 185.25 as that target. Next up, NVIDIA. I will say, and this script is now available on the website. You can go to tradebrigade.co/trading-scripts. It's also linked down below in the description. And you can find yourself this study right here. It's the IV rank, not the implied volatility study, but the IV rank is cooling off aggressively. So NVIDIA, if you're interested in trading it, your premiums are not going to be as inflated. This is a good thing for scalpers. This is a good thing for traders who really want to take advantage of not inflated premiums and maybe look for IV to increase to actually give you a boost in the premium in the underlying. So if we take a look at the actual price action here, it's a balance range. Obviously, bullish activity happens over the 50% mark. That's 894.50. Breaks higher lows over 922, tradable in the upward direction. Any consolidation in the lower portion, okay, maybe it's to the downside. I would tend to not really be a believer in the downside because of the look below and fail here on the Tuesday session, right? There's a breakdown. There's a lower high in that upper wick on the hourly bar. Let's zoom in a little bit more. There's your lower high, right? We start to break down. What happens? We get price acceptance back inside of the range. So where are the stronger sellers? They're simply nowhere to be found. They should have executed based on this breakdown. It did not take place. So for that reason, trying to navigate towards the top of the range, 922, then watching to see if we can get follow through in the upward direction. As an honorable mention still, we will jump on over to AMD and see what's going on over here. Bears remain in control out of AMD, right? You can clearly see this breakdown, end of day recovery effort from the FOMC, but it's just a huge series of massive lower highs, right? So if this is going to reverse in the upward direction, clear this level, then we can talk, right? So 183.60, if you remain underneath, this is consolidation and weakness. I would start thinking about what the opportunity is to close this gap down below. Under 172 closes at 164.60. Right now, thinking about the opportunities for lower high rejections at the daily 50 SMA, right? If you're just counting trend, what's the next most logical thing? We've got lows, lower lows, lower lows, highs, lower highs, possibility for lower highs, trading back down to an equal low, if not a lower low. And again, your gap is in force, and that is AMD in a nutshell. Next up, we've got the metaverse. What's going on with Zuckerberg's Fantasyland over here? Very straightforward setup as well. We are breaking back out of this balance range in the upward direction. So a couple of attempts to break down, right? You can see in here, successful attempt, not so successful attempt, not so successful attempt, and now we're over the top of that balance range. Keeps very straightforward setups in force, higher lows over 501.50, aligning with the bullish nature of the chart progressing in the upward direction. If the bears are going to take control, show me a lower high underneath that 501.50. Next up, we've got Tesla. What's going on with Mr. Musk trying to reinvigorate the rocket ship here? You can see we're breaking in the upward direction. We're recapturing the bottom end of this range. I don't know. I'm still not sold. If you take a look at the daily chart, and this is still going to be that option selling study set, let's go back on over to our daily and 50 SMAs. There we go. You'll just notice that the daily downtrend is really strong. There are massive lower highs from here to here. Possibility for lower highs still in this area. I don't know that I'm sold on Tesla until we get price acceptance firmly up and over this prior pivot low. If we were to get something that did this on Tesla's daily chart, maybe I'm more of a buyer under those circumstances, looking for some sort of bottom to form here, but still thinking about this as a counter trend move in the context of a pre-existing downtrend, right? So trying not to lose sight of that on the Tesla hourly. I would say there are scalps available to get to 182, and then we'll sort of take it in stride from there. If this just offers a rejection back down underneath 170, 73.15, that's a clear lower high short, right? All day long in the direction of the prevailing winds on the daily time frame chart. Next up, we've got Netflix. What's going on with Netflix over here? Finally breaking out over the sort of breakout point of the ascending triangle like such. If we continue to get price acceptance over that 623, great, looking for upside, and we know there's plenty of range to trade for into 644.75. You do not have to jump the gun. You do not have to be the first one in the door here. This was an FOMC breakout, so walking forward, wait for the structure to play nicely. Higher lows over 623, we'll trade it in the upward direction. Failing back down underneath, great, this is bearish consolidation. This is the breakdown that you participate in underneath 616 for a failed move in this zone right here. And let's finish up tonight's episode at 8 o'clock on the dot. 4 additional trade ideas for you. First one is on Eli Lilly. The ticker is LLY. Notice that we have a 3-day balance range here, Monday, Tuesday, Wednesday. And if we can break out over 773, those equal highs, we're trading into these highs at 790. That's the all-time high. But if we take a look at the hourly time frame chart, we actually had a thin structure round trip, if you will. A little bit of lift and right back down to the downside. Not very much structure in that area. So over 773, trading into 790. If you're going to try to execute this trade via options, just be mindful that they are a little bit spready and they're not the most liquid. The price is right. If you want to trade shares, there's enough sort of juice for your squeeze there, considering the price point here. Next up, let's take a look at BSX, Boston Scientific, keeping the theme in the healthcare sector. Let's take a look at the daily chart. Notice that we've got this failed lower low underneath this area in here on the low of that green bar. Now we're trading back up towards these equal highs. On the Tuesday and today's Wednesday session, the lower wicks of those back-to-back hammers are showing price acceptance above the Monday session high. If we take a look at the hourly time frame chart, you could even start to consider this some sort of sloppy cup and handle with a little bit of a spike in the midpoint of your cup. That's great, but over 68 trading into blue sky territory. So watching out for that as a possible outcome here out of BSX, bullish on the chart. Also, look at the strength of the overall uptrend, right? A little bit of a mild pullback here, consolidation, looking for continuation over 68. That's BSX. Next up, CMI, getting away from healthcare and jumping over to the good old 4-cylinder 4BT. 4BT was the common swap that was discussed frequently over in Ranger land. But 6 valve, 12 valve, whatever valve, 24 valve Cummins. What do we see out of the diesels here? Looking for, again, breakouts to blue sky territories. Look at the bullish engulfer today. A little bit of a, you could even consider this a 4-bar play where you get maybe even 5, right? 1, momentum to the upside, 2, momentum to the upside, 3, consolidation in the upper sort of portion of this rally to the upside. It starts to look like a bull flag at this point, right? 4, bullish engulfer opening at the lows of Tuesday. Looking underneath that low, closing at the high, equal highs across the board. Momentum bar number 5, will that take us into blue sky territories? That's the key question here, up and over 287.25. So watching Cummins for a break in the upward direction. Personally, have not traded this one, but the pattern is really attractive here. So I'm keeping an open mind to how it might act, even if it's just with a couple shares here into the end of the week. Next up, and lastly, we've got DBX, Dropbox. What's going on with Dropbox? Take a look at this thing. If there's going to be a squeeze, this is your squeeze. The unfortunate part is you can actually look at the short float, and it's only about 6% out of Dropbox. So it's not like we're dealing with, 35% short float or 45% short float. That would be awesome if that were the case, but it's not. The reality of the situation is 6% short float, but if we can clear this level, looking for some drift in the upward direction through the thin structure to retrace this nasty breakdown from the earnings announcement not too long ago. And that's going to do it for today's episode of the Midweek Market Update. If you enjoyed the episode or learned anything new, let me know down below in the comments section, or most importantly, by leaving the video a thumbs up and hitting the subscribe button. We'll, of course, be live up in the penthouse suites tomorrow morning for our episode of the pre-market prep. Come hang out with us. And with that said, I wish you a green trading week.